I've learned that most of those so-called expert stock pickers are just wrong much of the time, or most of the time. Now, how can that be? This just isn't logical. They are full-time stock specialists. They study stocks for a living. So it's logical to assume it would pay to follow their advice or to hire people like them, which is what you do when you buy a managed mutual fund, as most investors do. But here's a wild thought. Could I do better than those expertly managed mutual funds by flipping a coin? Or, as I showed earlier, throwing these darts at the Wall Street Journal? What'd I get here? Selectra Energy, Nippon, Emerson Electric. More. My darts landed on 30 companies. How would they do compared to the stocks recommended by managed mutual funds? Oops, better. From the start of the year till now, the stock prices of the companies hit by my darts increased by 31%. The 10 biggest managed funds rose only 9.5%. Okay, I admit I got lucky. Had I thrown the darts a million times to get to an average throw, my dart portfolio would have increased 12% this year. That's how much the average stock on that table has gone up. But that still beat the professionally managed funds. How can that be? And how can it be that study after study shows that picking stocks randomly or buying what's known as an index fund, a fund that owns a little bit of every stock, has brought higher returns than putting money in managed funds? It's so counterintuitive, but true. And years ago, my college economics professor wrote a book about that called Random Walk that explains why it's true. Burton Malkiel joins us now from Montreal, and in the studio is Fox business reporter Sandra Smith. Sandra, you say managed funds can be good. Contrary to popular belief, I say they actually are. Well, it's not contrary to popular belief. Most people still invest in them. Well, absolutely. But you're wrong. They're around for a reason, and you pay more for a reason. I mean, they would altogether go away, John, if nobody found value in them. Maybe they're all suckers. I take your example of throwing the darts. Take into consideration the time period in which you're looking at. 2010, the stock market, S&P 500's up 10% this year. The Nasdaq's up 14%. You're likely to throw that dart and you're going to pick a stock that's up because we're in an up year, which 75% of the past 85 years have been for the markets. So those passive investments work in this environment of low volatility and big gains. In other years it wouldn't, and in down years recessionary years, if you look back historically, research will show you that actively managed funds outperform in down years.
Not true. During this terrible decade, the lost decade of the first 10 years of the 2000s, more than two-thirds of actively managed funds were beaten by a simple, low-cost index fund, and the active funds that win in one period aren't the same ones who win in the next period. It's just absolutely clear. That's fine, but that's not the point. If you're looking at the periods of very high volatility, uncertainty, geopolitical turmoil, it's the actively managed funds that outperform. Whether or not there's still a loss on that year, it's still outperforming the broader market. Can you argue with that? Absolutely, because in fact, the actively managed funds at the beginning of the 2000s had loaded themselves up with these internet stocks, and it simply isn't true that they outperformed during the 2000s year after year. And there's a very logical reason for it. With an index fund or an ETF, you pay almost zero expenses. The average actively managed fund charges about 1 percentage point a year. And this is a game where they underperform by the amount of their excess expenses. This is a game where you get what you don't pay for. And I must say, to take the one study I found over 20 years from the Journal of Economics and Portfolio Strategy, of 452 funds listed for 20 years, only 13, less than 3%, beat the market
by more than they charge.
There's no doubt that this is correct. You have to ask yourself, are you, with your money, say you have $10,000, $50,000 that you want to put into the market because you're already saved up on your retirement, you're paying for your home, you want to take a risk with that money. Would you rather it be more protected to the downside, which an actively managed fund historically does, or would you rather be in an index fund and follow the crowd?
If you think an active manager is going to be able to time the market for you, you're just, you're accepting snake oil. And you might ask, well, why do people buy active funds? They buy them because Wall Street tries to tell you you can't do it yourself. We're smarter than you, and it's in their interest to do that.
Burton,
and they're selling you the snake oil because they make money doing it.
Burton, then who's determining when I get out of that index fund? You're saying that you're paying a guy to have the right timing to get in and out of the market? Well, then what's passive about an index fund if I have to decide when I'm going to get in, which index fund I'm going to get in, and when I'm going to get out? Not only that, there's a manager who's deciding what stocks are even in those index funds. So what's passive about an index fund?
Well, what's passive about the right index funds own all the stocks. That's number one. Number two, you can't time the market. When you try to, you buy at the top when everybody's optimistic and you sell at the bottom. So what you ought to do is dollar cost average, that is put money in as you would in a 401k plan, period after period. And yes, you will buy sometimes at the top, but you'll also buy sometimes at the bottom, and that dollar cost averaging means that when prices are low, you buy more shares, and this is the way you ought to do it. Don't try to time. It's a fool's game.
And Burton, let me just reveal my own conflict of interest here in that I certainly believe you, and you were my best economics professor I ever had in college. But what about those guys who do year after year beat the market, like Warren Buffett and George Soros and my own brother-in-law, Michael Steinhardt, who averaged 24% after fees for 29 years?
Sure. There are always some people who will beat the market, and you're right, Warren Buffett is an exception, and there'll be Warren Buffetts in the future. But the problem is, you don't know who they are, I don't know who they are, and if you try to go active, you're much more likely to be on the negative side of the distribution. It's like looking for a needle in a haystack, and I say buy the haystack, buy an index fund.
And I should add that my hotshot brother-in-law got out of the business and said it's harder to pick, and now he runs an index fund. So, and more investors are now moving toward index funds, and
there's nothing wrong with having a good balance. Let's put it that way.
All right, thank you, Sandra Smith and Burton Malcolm.